In this video, I will discuss flexible budgets and flexible budget reports. So what is a flexible budget? A flexible budget is essentially a series of static budgets adjusted for different activity levels. This is really important because it makes the budget more adaptable and more useful for evaluating managers. Basically, it ensures that when we're looking at actual costs, we're comparing apples to apples as it is with the amount on the budget. So let's look at the steps to developing the flexible budget. The first step is to identify the activity index and the relevant range of activity. Remember, the relevant range is the amount of activity where the costs maintain either their variable or their fixed status. The next step is to identify those variable costs and determine the budgeted variable cost per unit for each of those items. Then we need to identify the fixed costs and determine the budget amounts for each of those. And then lastly, we can prepare the budget based on the selected increments of activity within that relevant range. So let's look at an example. Here we have Animal House Manufacturing. They use a flexible budget for their manufacturing overhead department. The budget is based on direct labor hours. And then we are given the variable cost per unit, the fixed cost per month. Lastly, it says prepare a monthly manufacturing overhead flexible budget for 2018 for the expected range of activity using increments of 1,300 direct labor hours. So let's go through our steps. Our first step was to identify the activity index. And so it tells us that their budget is based on direct labor hours and that they normally operate in the range of 8,100 to 12,000 direct labor hours per month. So our relevant range is going to be 8,100 to 12,000 direct labor hours. Our next step is to identify the variable costs. Now in this example, they already gave us our variable cost per unit, so we don't need to go through and calculate the variable cost per unit. However, if we were given variable cost in terms of total, we would just take that total, divide it by the number of units, and that would get us our per unit amounts. Our next step is to identify the fixed costs, which were given in the problem. Okay, and it's not necessary to determine a fixed cost per unit because by their nature, fixed costs do not change as production levels change. And then lastly, we're going to prepare the budget based on the increments, and the increments that were given to us are the 1,300 direct labor hours. So we're going to start our budget at 8,100 hours and prepare it for every increment of 1,300 hours until we get to the end of our relevant range, the 12,000 direct labor hours. So let's look at the flexible budget. Again, we're going to start with our activity. Our activity is direct labor hours. And then in the problem they told us the relevant range was 8,100 to 12,000 hours. And we're going to prepare that report in increments of 1,300 hours. So we're going to start with the 8,100. Then we would move on to 9,400, then 10,700. And then our last one would be the 12,000. So now we're going to prepare a budget for each of these levels of activity. These are all budgeted amounts. Our next step was to identify the variable costs. Again, the variable costs were given to us in the problem at a per unit amount. So all we need to do here in our budget is multiply the level of activity, 8,100, times the per unit amounts, and we plug those into our budget. And we would do the same thing at the next level. And so on for the next level and our last one. It's simply a math problem of taking the activity level, multiplying it by the per unit amounts. And we can see that our variable costs are increasing as activity increases, which is what you would expect to see for your budget. Our last step was to identify the fixed costs and determine the budget amount for each cost. And again, our fixed costs were given to us in the problem. And because we know that fixed costs do not change as activity changes, our fixed costs are going to remain the same under all 4 levels of activity. And now we can calculate our total expected budgeted costs for Animal House Manufacturing for their manufacturing overhead budget at these different levels. Next, let's look at a flexible budget report. A flexible budget report is a type of internal report that can be used to evaluate a manager's performance. It consists of two sections. First, it has the production data for the actual level of activity, and then we have the cost data for our variable and our fixed costs. So let's look at a flexible budget report now for Animal House. So here it says, assume that in August 2018, Animal House Manufacturing incurs the following manufacturing overhead costs, and it lists them out. Then it says, prepare a flexible budget performance report, assuming the company worked 9,400 direct labor hours during the month. So first of all, anytime you see the word incurs, that is your hint that those are actual costs, not budgeted costs. So make sure you keep a lookout for that word. Now let's look at our flexible budget report for that level of activity. So again, we need to adjust our budget to match our activity level. So if our activity level was actually 9,400, then that's the amount that our budget should be based on. And the budget amount is just like your flexible budget. So we could go back through and calculate the numbers, or we could just pull them from the budget we did earlier and know that for an activity level of 9,400 direct labor hours, those are what our budgeted amounts would be. Again, these came from the flexible budget I did earlier. Next, we can plug in our actual costs from the problem that were given to us, the costs that were incurred. And we don't need to do any calculations because the costs were given to us in terms of totals, and that's what we look at when we're looking at a budget report. So I'm going to go ahead and plug those in, and now I can see my budgeted costs and my actual costs. Lastly, I want to calculate the differences, which is just the difference between the budgeted amount and the actual amount, and then I'm going to mark each of them as either being a favorable difference or an unfavorable difference. Because we're looking at costs here, if the actual costs are less than the budget, then that's a favorable, and if the actual costs are more than the budget, then that's an unfavorable difference. And we just put in a U or an F to indicate if it's an unfavorable or a favorable budget difference. And we can see here that overall, actual costs resulted in a $280 favorable variance when compared to the budget. And now this budget is useful for evaluating the manager because we can see where the costs were over budget and where the costs were under budget when we're comparing the actual level of activity of 9,400 with budgeted costs at that same level of activity.